that brand we have created on the basis of regular and continuous organizing webinars. So today it is our 183 webinar, which is unlocking the value through demerger and hive-off. Friends, if you remember, we have organized various programs on merger, restructuring, and other things. Then there was a demand that we should focus on specifically on demerger and hive-off, because this is one topic which is gaining attraction now, and various companies are planning to do this. As you are aware that previously in India, there was a consolidation that everybody wants to do business in one company, or they were doing business in multiple companies. This is a two heights. One is either they were having a different companies because of license issue, so multiple companies are there. Then there was a need that all companies which are not related or which are of the same nature should be merged. So there is an era where people have tried to merge and consolidate their business. But simultaneously, there was a need of also that in the process, what they have done, they have become a giant on multiple business in the same company. And then what is happening, the business which they were started, it has becoming a very big now. So the business, when it is becoming big, then there are so many other issues are also coming, and they are not getting the real valuation. Today, what is happening in the stock market, in the investor, in the PE sector, what they are doing one more important thing. They are investing money in the relevant sector. But when you have a 2 business, 3 business, 4 business, and it is not an identifiable thing that what you are doing multiple business, then in that case, the company is getting lesser valuation, mean the valuation which is the lowest they are getting. And if the company is having a better business, say IT business, say business of AI, which we are talking, business of e-commerce, that is getting a more and better valuation. But because of the other segment in the company, it is dragging the valuation. So the need has come that let's demerge companies, let's remove the company which are not relevant, or remove the company which has a less value base. So you must understand, earlier the people were doing business demerger because of the business is not connected to them. But today the business is connected to you, but the same business is getting less valuation. So you want to demerge or hive-off. So this is, as business is evolving, the need and agile and efficient restructure become increasingly critical. Demerger and hive-off are powerful tools that companies can leverage to unlock hidden value, streamlining operation, and create focused business units poised for success. These strategies not only help in optimizing resource allocation, but also in attracting targeted investment and enhancing overall market competitiveness. So this webinar, in a way, it's a webinar cum workshop, will provide you comprehensive understanding of how to tailor these restructure options to your business needs, serving as catalyst for growth and innovation. And in this session, we will discuss about various aspects of the law, because demerger issues is not only connected to us just one law. It is required the Companies Act, required income tax, because the taxation issue is a very serious issue, and the merger and demerger is taking place, and it is a sometime deal breaker also when you are finding that it's not a tax efficient. Then stock exchange listing, SEBI's permission. So say SEBI LODR regulation, you have to take approval from the stock exchange and SEBI. Then you have to go for the stamp duty calculation also. You have to plan tax. So these are the 2 outflow. And then one major compliance that SEBI see whether this demerger is not creating value diminishing for the minority shareholders. So these are the things which we will discuss today, and Manoj will explain to you. So I extend a very warm welcome to our learned speaker. First, Mr. Ashok Singh. He is the Deputy General Manager in Listing compliance in the BSc and has extensive experience of 15 years in listing, QIP schemes of arrangement and delisting. Ashok has receiving various approvals because all the approvals is going through stock exchange to SEBI. So Ashok is from BSc side is the person who is seeing, checking, and then approving. So his experience will definitely be beneficial to all of us, and he will tell us that what companies are doing normally mistakes and how they should change. So I welcome Ashok. Ashok is traveling. Despite of that, in the train he will participate. So I welcome Ashok, and this your gesture of despite of traveling, you are joined our webinar. Thank you very much. Then we have Mr. Manoj Kumar, partner and head M&A and transaction corporate professional. Manoj is a person who has done, I think, more than 500 M&A transaction, including demerger, merger of listed and unlisted company. So he has wide experience of all subject, and he's completely discuss all these points which I have talked to you. So friends, with these two learned speakers, they will today discuss in a way as a workshop also. So it's a strategic process where companies separate one or more business into two independent entity. So you can just understand there is a one company. Company is divided into two. The existing company is there, and another you have formed a new company and transfer the business. Sometimes what you are doing, the existing company is there and you are transferring these business to the two new entity, and existing company you are either retaining or you are closing. So multiple options are there, which is in the demerger. And then you have a hive-off also, that your business is there and one business you are selling to others. So you're not changing much, and as a slump sale you are doing, as a business transfer you are doing. So that is also another route of the demerger and hive-off. Without going to the court route, you can do this. So today we will all discuss all points and the implication on this. Now, sometimes people think that why strategic benefit of demerger and hive-off. Number one, the focus is enhanced. Focus enhanced means today what is happening, all business are going up. You are seeing index market is touching 80,000 or 25,000 Nifty. Then sometime it is a question that how? Because business is growing. So today everything is, today you have purchased a house or office or building or something. So that thing which you have purchased, today the rates are different. It's a multiplier. So same thing in the business also, because the business is improving, business is increasing, valuation is going up. So everything is taking shape. So that's why you are focusing on a business. That way you are not able to do it. So that's why if you divide this work, and you can do the focus on a different way. There is one of our client, very interesting story of demerger, which there was a family settlement. They divided the company into two parts, and one company, same business, same real estate business, but in one part they have a IT park. So they converted IT park into data center. Now the data center and real estate is two different things, but data center is also a part of the real estate, because without real estate you can't form a data thing. But if you are doing in a same company, you will not get that focus. So that's why they are making a subsidiary company on data center, because that's a very technical job, very technical things that is divided, and the professional management is managing separately. So you are doing focus. Same if you see NIT, they have done. So they have changed this learning business to that part, another business other part. Interestingly, Tata Chemical. Tata Chemical is a one company which is a jumble up of various business. So they are having a business which is a consumer product. So Tata Chemical is doing so many things. So now they have made it Tata Global Beverages is a separate part. So that's why the beverage business and chemical business is separate, focus is separate, and that is a consumer B2C and this is B2B. So you cannot give the same focus. You have to change this accordingly you are doing. So today we will discuss all these aspects and how this enhanced focus is taking place. Value unlocking, that is also because sometimes what is happening, if you are having a merged, all you have a same group companies having a multiple business in a one company, then you're not getting a that valuation which I have told you in the beginning. So you divide into multiple parts, and then each industry has a different valuation, different P, so you can get. Otherwise, you are getting the lowest P of that entire business. Operational efficiency is also there because when you divide, then it's just like a you divide the state of the in India, like Madhya Pradesh and divided into Chhattisgarh and Madhya Pradesh, UP is divided Uttarakhand and this. So that way, this is all the same process, and everybody is saying because of this, efficiency improves. You can more focus. You can do something. Investment attraction is also there because targeted investor is now investors are not coming that they want to invest in one company. Some investors are only they are investing in IT company. Some investors are in real estate. Some investors in data centers. Some investors are on a consumer business or e-commerce or IT. So you will get a better valuation if you find that type of investor. Risk management is also managed. It's a risk mitigating process because one business sometimes it's creating risk. So you are dividing. So both the business should not get the hampered because all the regulatory business is always having a risk. That is one part. Then improved governance, like corporate governance, is also improved because management is focusing and they are focusing and try to improve the newly formed entity with new performance. Flexibility and agility is also increasing efficiency. Organizations are changing and they adopt a new market strategy, new changes and new things. So that is some advantage. Now I will request Manoj to discuss today the understanding demerger and hive-off, strategic benefit of demerger and hive-off, regulatory and compliance landscape, financial implications, taxation and accounting issue, and operational or national challenge. These are the things Manoj can discuss in detail. And then I will request Ashok to tell us that what mistakes companies are doing. So that's why there is taking too much time and how to reduce that time and how to give the best result to this part. So without taking other things, I just request Manoj, please go through and explain to the participant about this entire gambit of demerger. Over to you, Manoj.
Thank you, sir. Good afternoon, friends. So today's topic is very, very important for any corporate, like merger amalgamation, where the objective is to inorganically grow the company or the size of the company, enhance the size of the company, or do the geographical expansion for the company. The demerger is just opposite to the same, and here we are separating two or more businesses from the company. The objective is to unlock the value of different companies, have better focus. And as sir has said, this has gained momentum in the recent time. We can see recently Reliance has separated the Geo Finance. ITC has just filed a scheme to separate the hotel business from its main cigarette and FMCG business. Similarly, Vedanta has dividing its into several 5-6 entities just to focus on different kind of businesses. So this is gaining a momentum, and in most of the cases, the companies are having much better valuation when they are separating different businesses. So it is a very big unlocking of value for the shareholders of the company. Today, as we will discuss about what various ways of demerger or hive-off and their pros and cons, what are the legal complications, what are the taxation issues, etc. So let me share my presentation. So to start with, So the broader agenda is to understand insight into the corporate restructuring, including merger and demerger, then understanding the demerger process, then to have discussion on the just a minute, it is taking yeah. So exploring the slump sale, then slump sale demerger versus slump sale, and then insight into the various real-time cases, recent cases, which has helped to unlock the value, and what are the pros and cons in the same. So if we, as we discussed, the merger amalgamation is done with the object of inorganic growth. It may be horizontal expansion, geographical expansion, consolidation of businesses, for cost optimization, backward or forward integration, or it may be adding new line of business for considering the future of the business. Similarly, the demerger is for unlocking the value. Main object is to unlock the value. There may be different object like family separation, segregation is also there. So leadership issues may be there. Then the focus on the core business of respective companies, respective entities happens. It also segregates the risk of the company. So these all are the major reasons for demerger or hive-offs. Understand. So if we talk about the demerger is a process through which one company is separated into two or more companies, and the business, some part of the business of one company, existing company, is transferred to another company, which is generally called the resulting company. There may be, for each scheme of demerger, there will be tax implication. The company law is the prime law for that. If it is a listed company, then SEBI regulations would come into picture. Stamp duty implications would also be there. So we have to consider all those factors. So to start with, the company law does not define demerger or merger anywhere. It generally talks about the scheme of arrangements. However, income tax clearly defines the term demerger, and which is defined under section 219AA. Here, the demerger is the process of transfer of one or more undertaking of one demerged company into a resulting company through a scheme of amalgamation arrangement. This is the definition of demerger given under the income tax. There are certain other conditionalities with respect to the demerger that the conditionalities are it has to be a transfer of an undertaking. So it cannot be a transfer of single asset or single liability or set of assets and liability. It has to be a business as a going concern, business activity. So it may be part of an undertaking, but it has to be capable of running as a separate business entity. That is a precondition to be a demerger. Besides that, there are certain other conditionality to make the demerger scheme tax neutral or tax efficient. So the conditionality is that all assets and liability of the undertaking should be transferred. Then the resulting company should recognize all assets and liability at their respective value, ignoring revaluation if there is any. Then the scheme must, post scheme, the consideration should be in the form of shares. So at least 3/4 of the total shareholder of the demerged company should become the shareholder of the resulting company as part of the scheme. And resulting company should issue shares in consideration of the demerger on proportionate basis. Then the transfer of undertaking should be on going concern. If these conditionalities are getting fulfilled, then it will be considered to be a demerger under income tax. Though Companies Act, these conditionalities are not there. There may be different kind of arrangements also, but to become a demerger within the meaning of income tax, conditionalities are very important. If we are fulfilling these conditionalities, then there are certain exemptions given under the income tax. So if the process is a demerger within the meaning of 219AA, then the transfer would be ignored to be a transfer. So there will be no capital gain for the transfer of assets and liability from demerged company to the resulting company. Similarly, there will be no capital gain in the hands of the shareholders of the transferor company if they are getting shares of the resulting company as consideration of the demerger without any consideration. That will be there will be pure pass through there. Then there is a specific provision relating to transfer of unabsorbed depreciation and losses relating to the demerged undertaking. So if there is in a business there are two or more businesses and one business is getting losses, continuous losses, and that is identifiable, and we hive off that division into a separate company, then the new company can take the advantage of carry forward of losses, which is generally available up to 8 years from the date of incurring of the loss. So that losses would get transferred into the resulting company. Similarly, unabsorbed depreciation would also get transferred to the resulting company and will continue to have available to the resulting company for next 8 years. Oh, sorry, depreciation would be available for unlimited period, and the business losses would be available for 8 years. In case the losses are not directly relatable to, or depreciation are not directly relatable to each businesses, then we have to do it on proportionate basis and we can carry it forward. Another important tax is the indirect tax, that is GST. So goods and services tax specifically provides that the transfer of business undertaking from one company to another as part of any scheme of demerger or even hive-off, if it is being done on a going concern basis, then this will not be considered to this will not be taxable event. There will be no GST implication on the same. Then there is a specific provision with respect to use of unused input tax credit of the GST of the division which is getting transferred. So that clearly says that the ITC benefit would be transferred to the extent of the value of the asset getting transferred from the demerged company to the resulting company. So it totally depends upon the value of the assets being separated. It is not relating to the size of the business, let's say turnover based. It has to be on the basis of the size of the assets. So as the business, demerger process requires segregation of the company into two parts or to more than two parts, and the consideration is directly given to the shareholders. Hence, it is not a simple transfer of share or business transfer, and this requires approval of National Company Law Tribunal in compliance with the company law. If we go deep into the process, the first important section is Section 230 of the Companies Act, which generally talks about the scheme of arrangements. The scheme of arrangement does not specifically talks about the merger demerger. It can be any kind of restructuring within of the company. So demerger is also a type of restructuring where one or more businesses are getting transferred from one company to another, and the shareholders of the company are getting shares against that. So that the requirement is that there will be approval from the shareholders, and that approval has to happen through 3/4 in value and majority in number. Then there is a Section 232 which talks about, which specifically deals with the merger or demerger. So here the approval merger or demerger scheme need to be in compliance with the Companies Act, and it will require approval through the special majority as given under the Companies Act. So the conceptually first step is this. Generally, it is assumed that the scheme of demerger or merger or any kind of arrangement requires a specific provision in the object of the company or articles of the association of the company. But that is not the case. There is a well-settled position that merger demerger is inherent power of the company, and it is provided under the law. So irrespective of the provision in the articles of association or the memorandum of the company, a company can enter into a scheme of arrangement, including demergers. The scheme need to be approved by dual majority of the shareholders as well as each class of creditors. So that dual majority is 3/4 in value as well as majority number of the persons present in the meeting in which it is getting approved. The meeting may be physical meeting or it may be through postal ballot or e-voting system. Same goes for the creditors, each class of creditors. So there will be separate meeting for each class of shareholder and separate meeting for each class of creditors, secured creditors, unsecured creditor, deposit holder, etc., etc., if there is any. There is a specific provision that any scheme of arrangement can be objected by a class of creditor or shareholders. So for shareholders to object a scheme of demerger, if they are disgruntled, if they feel that it is against their interest, then if they are holding at least 10% of the total shareholding of the company, then they can object to the scheme in the NCLT. Similarly, any class of creditors holding 5% or more of the total debt of the company can object to the scheme in NCLT. There is a specific provision in the Companies Act relating to dispensation of meeting of creditors or a class of creditors if the company is in a position to obtain no objection from at least 90% of the class of creditors in the form of affidavit, then they can seek exemptions from the holding of meeting of that class of creditors. There is no specific provision with respect to dispensation of the meeting of shareholders. However, in practice, many of the NCLT benches allow dispensation, which is also supported by several case laws of the old era of high courts. So the procedurally, if we talk about the demerger, it starts with the preparation, which is formation of the scheme, carrying the valuation, or in case it is a vertical split of a company, there is no need for valuation of the two divisions. It is generally called the shared entitlement ratio. So entitlement ratio may be 1:1 for both the company. It may be 2:1, 5:2. Any suitable combination can be made, and it can be made part of the scheme. This entitlement ratio need to be certified by a registered valuer as per the law. Then the scheme would be approved by the board of directors of each of the companies involved, and then the same shall be filed with National Company Law Tribunal, having jurisdiction over the registered office of respective companies, to seek the directions for calling of meeting of shareholders as well as creditors of each class. And in case there is no objections from creditors of each class, then any particular class, the exemption can also be sought from the NCLT bench. If the shareholders and creditors meet, and the shareholders and creditors meeting happens under the supervision of the court-appointed chairman and the scrutinizer, and if the scheme is approved by the appropriate majority, as discussed earlier, that is 3/4 in value and majority in number of the persons present and voting in the meeting of each class, then the scrutinizer would submit their report to the chairperson of the meeting, and the chairperson of meeting would submit their report to NCLT. After considering that approval by appropriate majority of shareholders and creditors, the court allows second motion process to start, which is the final approval of the scheme. So at this stage, the notice is served to all other to various regulators. That includes ROC, official liquidator, and so in case of demerger, the official liquidator's role is not there, but regional director of Ministry of Corporate Affairs, Income Tax Department, for their consent or comments on the scheme of arrangement. Post that, there will be a public notice for collecting the objections, if any. And after that, after considering all the objections or report of the regional director and different regulators, as the case may be, the scheme is approved by the NCLT. So this is the whole process of NCLT. Post that, the order of the NCLT.
Manoj.
Yeah.
Just explain the number present, because there is always confusion. Go to the second back. Just go back,
Yeah.
and then go again.
Mm-hmm.
This number concept is always confusing. At present and voting. So can you just explain this?
Yeah, so generally there may be lot many shareholders or creditors of any class. So if we are holding a meeting of shareholders or creditors under the supervision of court-appointed chairperson and scrutinizers, the persons who are present in the meeting on appropriate time prescribed would only be considered for the purpose of approval. So at that moment, let's say there are 1,000 shareholders. However, in the meeting only 100 are present, and out of the 100, 51 is giving positive vote to the scheme. Then one test is fulfilled. The other test is 3/4 in value. So let's say these 51% shareholders are holding 80% in value of the shares held by all these 100 people. So their approval would be sufficient, because that would constitute 81% voting in favor of the scheme. So 75% in value term and simple majority in number term is approved, then the scheme is considered to be approved. But if we talk about the exemption from the holding of the meeting of shareholders and creditors, then the concept is entire value of the creditors. So in that case, let's say there are 100 crore of secured creditors, and to seek the exemption from the meeting of secured creditor, we need at least 90 crores in value term to give their consent in the form of affidavit. So these are the two different scenarios, and this is the way how it is calculated.
Okay.
So post approval of the scheme, there is a requirement of filing of this order of the NCLT with ROC, and the filing of order becomes the effective as soon as it is filed with the ROC. So post that, there will be accounting and etc. Procedural implication of the scheme getting fulfilled. Now the process become a bit more complicated if it involves a listed company. So as soon as there is a listed company involved in the scheme of demerger, there is a requirement to seek to comply with the requirements of SEBI LODR regulation, listing regulations. So there is a specific provision, regulation 37 is there, and section for regulation for 59A is there. So regulation 37 generally talks about the process and under which there is a SEBI's master circular, which need to be complied with. So as per regulation 37 of LODR, any scheme of amalgamation or demerger involving the listed company requires to be filed before the stock exchange and SEBI, and for their no objection. And the company can go to NCLT only after obtaining the no objection from the respective stock exchanges and SEBI. The SEBI generally does not come into picture directly. It works through the respective stock exchanges. If there are more than one stock exchange involved, then the company is required to determine one of the exchange as the designated exchange to correspond with SEBI. So, and the law says that as soon as the SEBI's observation, stock exchange observation comes to the company, the scheme must be filed with NCLT within 6 months from the date of that observation letter. So, if the listed company is involved, the master circular requires following 12 major things. One, the draft scheme need to be filed with the stock exchange along with the valuation report of independent registered valuer. There will be a fairness opinion by a SEBI registered category 1 merchant banker. Then the valuation report and fairness opinion should be placed before the audit committee, and their report and recommendation on the scheme is very important aspect, which is to be presented to the stock exchanges. Then there will be a requirement to file the pre-post shareholding structure of the company. So in case of merger, the pre-post shareholding of the resulting listed company changes. However, in case of demerger, the pre-post shareholding of the resulting company need to be provided. If it is not already listed company, it is a closely held company, then the pre-holding would be generally considered to be part of the promoter group, and the post there will be promoter as well as non-promoter. And then audited financials for 3 years, and the financial which is not older than 6 months to be presented. This stub period financials need also to be audited. And then the auditor certificate certifying that compliance of the prescribed accounting standards, and a detailed compliance report is to be obtained after 21 days of the filing of the scheme with the stock exchange. Then there will be a requirement of committee of independent directors to give their observation about the scheme. And before obtaining the no objection from the stock exchange, there is a requirement to obtain at least 75% of the secured creditors no objection to the scheme.
So here, independent director's opinion, which you report you take,
yeah,
like takeover, you are telling that this is good or not bad, but here, because it's a demerger, so it's divided into 2 parts. So what is the basic issue which these independent directors are finalizing or giving opinion?
The object is similar, whether the scheme is beneficial to the interest of the public category shareholder, that they'll generally look into. So all demerger schemes are not vertical split of the company. There may be situations where one part of the scheme business is getting transferred to another company, which may or may not be a listed company. So in all such circumstances, the swap ratio, the entitlement ratio need to be considered by the independent directors committee, and they would give their observation whether it is beneficial to the interest of the shareholder or all stakeholders or not. So that is the general criteria. It is very much similar to takeover of open offer.
Okay. Okay.
Then there is the general regulation 30 of the LODR is always triggered wherever there is a price sensitive transaction, wherever there is a material transaction which can have impact on the value of the shares of the listed company. So there is a requirement to disclose. So here again the disclosure requirement comes as soon as the board of directors of listed company approves the demerger. It must be intimated to the stock exchange within 30 minutes along with all the basic details of the scheme. Wherever there is a demerger of a listed company and the shares are being granted by a resulting company which is not a listed company, generally it is provided that the resulting company would be listed on same stock exchange where the demerged company is listed through a process which is a relaxation from Rule 19(7) of the Security Contract Regulation Rule. This exemption relaxation is provided by SEBI. So that provision is also inbuilt in the master circular provided by the SEBI. So the conditionalities are such that equity shares sought to be listed is allotted to the shareholders of the listed company. At least 25% of the post-scheme shareholding of the resulting company should be held by the shareholders, public category shareholder of the listed company. That is one of the major conditionality. And there is no, the transferee company will not issue or reissue any share which is not covered under the scheme. These are the conditions. Besides that, there are 3-4 other major conditions. As on the date of application, there should not be any convertible instrument or warrant in existence, which can create a new shares, additional shares in the resulting company. The transferring entity is if there is a lock-in shares in the demerged company, a similar number of shares, the shares allotted against those shares would also get logged in for a balance period of time. There may be additional conditionalities which could be placed at the time of granting the exemption by SEBI for listing. So it is, I think here it is very important that because of this provision, without IPO, many companies get listed through the scheme of demerger, and that is one of the major way to unlock the value for the public category shareholders. So we have seen, like we were discussing, the ITC demerger. So there will be two companies. One will be continuing to be the ITC main ITC Limited, and another ITC hotels would get listed through this scheme. The timeline is around 15 to 20 months from the date from the approval. Similarly, in many of the cases, the government is also doing the demerger of many of the companies, like we have done for Shipping Corporation of India, where all the land and asset company got demerged from the main shipping business, and now it is separately listed. So both the companies start getting traded on the stock exchange, and hence it gives liquidity to the shareholders and options to continue in one company and exit from the other. So this is a good unlocking of value for the company. Now we come to the another important aspect and one of the major cost implication in any case, any scheme.
Manoj, just go back.
Okay.
The compliance part of this rule 19(2)(b), when you are applying to SEBI,
yeah,
what is the basic point SEBI looks into this? Because one way is there's a mirror image of shareholding. Okay, one option is this.
Yeah.
One is you are divided into two parts, and that is also shareholders acting the same thing. So in merger, there is one issue that shareholding will change. But here, shareholding can change. But if there is a mirror image of transaction,
yeah,
then what SEBI is looking in demerger? What is the
So
more?
in most of the cases where there is a vertical split and mirror image shareholding, then only procedural aspects are getting checked by SEBI and stock exchanges because they have already given in principle to the scheme in the beginning. So they just vet that the scheme originally filed with them is coming for listing at the time of listing, or there is a deviation during the process of NCLT approval. So that checking is done, and the other conditionality, like at least 25% shareholder, public category shareholder is continuing to be here in the company getting listed. Then there is no convertible instrument or warrants or any agreement or understanding in the resulting company to have additional shares, equity shares in the company and at a later date, which is not part of the scheme. So those conditions are getting checked, and in most of the cases, invariably they grant the exemption. Obviously, it is just a procedural time aspect. Other than it will be done. The complication comes wherever there is a company which is in existence, which has a business, and hence because of that the mirror image shareholding is not getting created. So the listed companies, let's say in the existing listed company, promoters holding is 30%, and post demerger, the resulting company's promoter holding is 60%. So there is a huge gap, and that need to be checked by the SEBI. So there they look into deeply the shareholding, the valuation report, the swap ratio decided in the scheme. Now comes other important aspect and the cost aspect, which is the stamp duty. So as a matter of principle, all scheme of arrangements, whether it is for merger or demerger, would be subject to stamp duty. So there is no exemption because of the Supreme Court's landmark judgment in HLL case. All schemes are subject to stamp duty because this order of the High Court, or now NCLT, is considered to be a conveyance deed. But the rate of duty is totally state subject, and it varies from one state to another. There are certain states which have defined the rate of duty, but there are other states which have not defined, and hence the normal rate of conveyance is applicable. Like in case of Delhi, there is no specific rate of duty, but for conveyance there is a rate of duty of 3%. And in Delhi Towers judgment, the High Court of Delhi has clearly mentioned that this is the applicable rate which is applicable, and hence the same is applicable in all schemes approved in Delhi. But there are other states which have created a beneficial rate of interest, like stamp duty, like Andhra Pradesh, 2% of the value of fair market value of the property getting transferred. In case of Chhattisgarh, 7.5% of the market value of the property located in Chhattisgarh, or 0.7% of the aggregate value of shares issued, whichever is higher is applicable. In case of Madhya Pradesh, 5% of the market value of property in Maharashtra, Madhya Pradesh, or 0.5% of the value of shares allotted, whichever is higher. So similar rate of different rates are for Gujarat, for Kerala, for Haryana. Separate rates are provided, and we have to go by those rates and accordingly get the assets transferred in the name of the resulting company. Now we may discuss the alternative structure of demerger.
Manoj, just tell me in stamp duty.
Yeah.
The stamp duty, how much it is a hindrance or it is a deal breaker?
In many of the cases, this duty cost would be quite high, specifically where the assets are held are situated in different states and the registered office are in different states. Then there may be dual duty implications. As this is also well settled position that if there are two companies are involved in a scheme and they have registered office in different states, both the states have their own right to charge the stamp duty as per their law. So, like in case of old Reliance Petroleum merger case, Bombay as well as Gujarat, Maharashtra as well as Gujarat have charged their duty, and after long drawn battle, ultimately Reliance has to pay duty in both the states. And though there is no set off. So this can be a complication and obviously a cost to the company. For a smaller company, it may be, let's say, transfer of old property, which is lying in the books for 30, 40 years. The rate of the present value circle rate would be much higher, and the duty cost can be in crores. So that can be a complication. But if the business logic is larger than these costs, then
But
obviously
this is the outflow which is immediately.
Yes, it has to happen within 60 days. The law says that within 60 days of the order of the NCLT, the company should approach to respective tehsil or the respective SDM of the stamp and place themselves for adjudication. Post the adjudication time sometimes is much longer, but post that order is passed and accordingly duty is deposited.
Suppose you are delaying that, what is the penalty on this?
The penalty can be up to 10 times of the value of the stamp duty payable. So that totally depends upon the SDM to pass the order. It may be one time additional or maybe up to 10 times additional. So in some cases we have seen up to 3 times they have charged as an additional duty.
Okay.
Now comes to the second chapter, which is the slump sale or hive-off. So slump sale is the transfer of one part of the business from the company to another through a normal process. So again, it will require tax implication. It will have being a company law requirements, being a list. If it is a listed company, SEBI LODR would come into picture, and there may be a stamp duty implication here also. So slump sale is defined under the income tax as transfer of one or more undertaking as a result of the sale for a lump sum consideration without valuing each individual assets or liability. So it may be 3 main components are there: transfer of whole undertaking, sales should be on going concern basis, and there should be a lump sum consideration. If these conditions are getting fulfilled, then it will be considered to be an income tax, slump sale under income tax. Undertaking is not specifically defined, but generally undertaking means any part of the undertaking or unit or division of undertaking which can be which is a business activity taken as a whole, but it should not be an individual assets or a group of assets or group of liabilities simply. So why it is important to have the definition of slump sale fulfilled, because otherwise it will there are certain exemptions in some cases which would not be available to the company if this definition of going concern is not fulfilled. So typically it is the slump sale happens through a business transfer agreement, and business transfer between the transferor company and transferee company for a lump sum consideration. It is a fast track process because there is generally no regulators involved. It is a private transaction of between the company. So generally it is up to the company to decide how fast they can do the transaction concluded. Tax implication. So income tax and GST, there are two different tax. Obviously, income tax is applicable to all slump sale. There is no exemption as such, except in some cases we will discuss later. Under the GST law, there is no differentiation between the demerger and slump sale or hive-off of a business as a going concern. If we are fulfilling the conditionality of going concern transfer of a business, then the transfer would not be a taxable service under GST and will be exempt. Similarly, for taking benefit of the ITC credit available to the entity, to the division which is getting transferred, the law is very much similar to the demerger. And here again, we have the transfer can happen in proportion of the asset's value of entire asset and the asset getting transferred. There will be capital gain implication in the hands of the company which is transferring the business, because they will get the company which is transferring the business would get lump sum consideration. So that need to be assessed for capital gain or loss, if any, and taxability would arise accordingly. Yeah. So let's capital gain. So long-term capital gain, generally it is if the entity which is being transferred is held by the company for 36 months or more, it will be long-term capital gain. At present, the rate of long-term capital gain is 20%, and as per the proposed Finance Bill 2024, it will be 12.5% of the gain earned through the transfer. if the undertaking was held by the company for less than 36 months, then it will be normal tax rate applicable to the company. So it is a short-term capital gain. How to calculate the capital gain? So the fair value of the consideration, which is getting fair market value of the sale consideration, which is getting against the slump sale or transfer of undertaking, and the net worth of the company or the cost of acquisition of the division. The difference will be capital gain or loss. So that is the calculation. In case the consideration for transfer of the undertaking or business is consideration rather than cash, that let's say shares are getting issued against the transfer of undertaking, then the fair market value of that consideration would also be considered as a fair market value too. So there will be two different fair market value here. One, fair market value of the assets getting transferred, assets minus liability getting transferred, and the fair market value of the assets received as a consideration of the slump sale. Whichever is higher would be considered to be the total consideration, and based on that, the loss or gain will be determined for capital gain purpose. So the value of the cost of the undertaking would be determined based on the WDV of the assets held by this, and because it is a running business, there will be no indexation benefit available in case of slump sale. Then
Manoj,
if
Manoj,
yeah.
can you explain this going concern and how to determine what is the advantage and disadvantage of going concern and normal organization which is not a going concern?
So going concern, here the concept of going concern means capability of the business or a division running as a separate business unit. That is the test. It is not about the going concern at the time of transfer. There may be a situation where at the time of transfer, the division is not a running business as such, but there is a potential to run as a separate business. And again, in such case also, it may be considered to be a going concern. So it is a practical thing, whether it's a business or it is just a business asset. Like if we are transferring one factory land simply, it may not be considered to be a slump sale or a going concern transfer for the purpose of income tax. However, if we can say that this can be run as a business, though it may not be getting run managed at the moment, and we can convince the department, if there is a scrutiny, that it was intended to be run as a separate business and it was started immediately, then it may be considered to be a going concern transfer. If going concern transfer happens, then obviously if the first benefit is right now, there will be no GST implication. Otherwise, the transfer of assets other than immovable property would be subject to GST as a service rate, which is 18%. So that can be a big cost. Similarly, like I am now discussing the exemption available, so that exemption would not be available if it is not a transfer as such. So there is a specific exemption for transfer of capital asset from the parent company to its wholly owned subsidiary, and that is exempt from capital gain. This exemption is subject to two conditions. One, the assets getting transferred to another company, which is wholly owned subsidiary, should not make it stock in trade or at any time. And the other condition is that the parent company should continue to be holding 100% equity of the subsidiary for at least 8 years. Otherwise, if that condition is not getting fulfilled, then the exemption available taken under section 47(4) or 5 would be cancelled, and that tax would be payable from the very first day.
And Manoj, who will calculate the 8 years? Either you have to go or income
It is a
tax.
self assessment. The company has to determine and claim the exemption. And later on, in case there is a, let's say, holding company transfer certain shares, then it should calculate the tax implication and pay the tax themselves, unless there is a scrutiny or by the department and they come out with this. So all income tax is self-assessment. So we have to go ourselves and claim the exemption or claim that exemption is no more available.
Okay.
Under company law, the slump sale or transfer of undertaking is governed by section 181A. So 181A is basically transfer of undertaking, which is subject to certain approval. Before that, if that threshold is not getting fulfilled, then it is a general power of the board of directors of the company to decide transfer or sale of any undertaking or business of the company. But if this threshold, which is basically 20% of the total assets, is considered to be undertaking, a separate undertaking. So if there is a undertaking which is being sold or leased out or otherwise disposed of, then it requires approval of shareholders through a special resolution, and this is applicable to public companies only. Undertaking means undertaking for this purpose is defined to be either of the two condition. One is 20% of the net worth of the last audited balance sheet of the company in the or 20% of the income should be coming from that business which is getting transferred. The substantially whole of the undertaking is also the meaning the same, considering the last audited financials of the company. If those conditions are getting fulfilled, then obviously it requires approval from the shareholders. And other implication, maybe if it is a related party transaction, then the application of section 188 may also get attracted. In case it is a listed company, additional requirements are provided under regulation 37A that requires listed entity to follow stricter regime for disposal of undertaking. It provides certain conditionalities which are as under. One, the vote in case the company decides to sell or dispose of one of the undertaking, then the vote casted by the public shareholders in favor of the resolution should exceed the vote casted by such public against the resolution. The disclosure of object and the commercial rationale should be clearly defined in the explanatory statement. The public shareholders who are related party directly or indirectly to such resolution cannot vote in the resolution. Disclosure of use of the proceeds should be clearly defined and it should be reported in the financials of the company. So these are the additional conditionality. However, this regulation 37A would not be applicable in case the transfer is to its wholly owned subsidiary. As there is no change in the control structure, the approval and the business remain within the fold of the company, which is owned by all the shareholders. However, in case the post-transfer of undertaking to another entity, listed company intends to dilute its holding in the wholly owned subsidiary, then Regulation 37A get triggered. Here again, what is the stamp duty implication would be there. There is no special rate provided for transfer of movable or immovable property through a scheme of through slump sale or business transfer agreement. So the immovable property transfer would be subject to normal rate of duty as available for any conveyance deed. So that is applicable. For immovable property, generally there is no specific requirement of having a deed of transfer. Hence, generally the business transfer agreement provides that all movable property will be transferred by delivery, and hence no ad valorem duty would be applicable for movable property transfer. It will be the business transfer agreement would be on normal stamp of 100 rupees or as the case may be to a specific states, and that would help to get the business transferred. So for business transfer, obviously, through the scheme through the BTA, immovable property is getting transferred, then the BTA must be registered or a separate deed of transfer must be registered, and that would be subject to conveyance rate of stamp duty. So if we compare the two methods, one the slump sale and the demerger, there are quite a few pros and cons for both the things. So we have to analyze the same before taking a decision. So if we talk about the slump sale has no specific exemption from the capital gain. So generally the slump sales are subject to capital gain. The unabsorbed depreciation or losses cannot be carried through slump sale agreement. Whereas in case the demerger happens through NCLT approved route, then the transfer is subject to there is exemption from capital gain in the hands of the transferor company, as well as the shareholders who are getting consideration as a share in the form of shares. The unabsorbed depreciation and the losses would get carried to the resulting company, and they can take advantage over a period of time as per the law. But the slump sale is very fast. It requires much lesser regulatory approvals. The process is also fast tracked. The shareholders approval is normal. Let's say even if Section 181A is applicable, it is simple majority approval. But in case of demerger, it requires approval from shareholders and all class of creditors, which is not applicable generally in case of slump sale. However, there may be arrangement or agreement with the lenders who have put certain conditionality, so that need to be fulfilled. So generally, unless there are certain regulated business, the process of slump sale happens within 3-4 months. But in case of demerger, the normal timeline is around 7-8 months, and in case listed company involved, the process becomes 5-6 months longer. So operationally, the slump sale happens through BTA, business transfer agreement. Generally, the consideration is cash. Sometimes it is in the form of issue of shares by the transferee company. The purpose is generally the strategic. It is to sell the certain business or certain assets and raise cash to reduce liability, etc., or to remove unwarranted, unconnected business from the company and focus on the core. Whereas generally the demerger is more strategic in nature. It involves create two parallel entity. There may be alignment of the business focus on the management. There may be separate leaderships. So those things, there may be family settlements where one group is managing one part of the business, another group is managing other, so that can be separated. Then there may be two businesses which have different market valuations parameters, so if they are separated, the different valuations can be achieved for both the entities. So it helps in unlocking the value. It also helps to attract investors who are focused to certain businesses. So these are more strategic in nature, more complicated, but more beneficial. So generally, in case of demerger, the consideration goes to the shareholders, so they feel rewarded for the transaction. Whereas in case of slump sale, the consideration goes to the company which is transferring the business, and hence directly shareholders does not get any major benefit out of it. So this is the broad thing between the broad discussion with respect to the merger or demerger. We will discuss a few case studies to understand how these demergers help to unlock the values for the companies. Most of the sir.
I'm just asking.
Yeah.
If you go through we have seen your presentation.
Yeah.
As a company, as a professional in the company, it requires company law knowledge. It requires SEBI if the company is listed. It requires income tax knowledge. It requires stamp duty. It requires accounting standard, accounting point of view also.
Yeah.
Okay. So all these things are then the most important thing, the market, the business. And the important point is that if I do demerge, what valuation I will get? These are the things. So do you think it is not a it's required 360-degree knowledge and expertise and experience to do this, because these are the long-term things, and you require a multiple knowledge. Once you are starting, you can't go back. Okay, so so when you discuss the case study, then you discuss this also, that what problems all these companies have faced, if are there, and you can share some of your experience after Ashok's after your this unlocking value. I'll request Ashok to tell, and then you can discuss some of the problems when the companies have faced, which people should remember, the professional should take care in advance.
Right. So generally, obviously, all merger, amalgamation, or demerger is a very complicated, time-consuming, and very strategic kind of transaction which happens in the life of corporate very few times. So obviously, the internal professionals may not be fully equipped to handle all these things, and hence there are consultants who are well equipped, who have experience, are taken care of. So they take care of each aspect of the scheme, the formation of the scheme, the valuation, the fairness understanding, the secretarial compliances, the legal compliance, the tax compliances. All those things are taken care of by these experts, and that is always advisable to take the advice of expert third party advisors. Otherwise there may be complications in the way, because it's a long process, one and one half year process. So there can be, anytime there can be pitfalls. So it is always advisable to take the benefit of others. Yeah, so I'm discussing a few cases where it helped to unlock the value and logic behind the transactions. The first one is demerger of the CLG business undertaking of NIIT. So NIT has also done a demerger in past, where NIT was demerged into technology business and the coaching business, the center business where they were teaching the things. Here now they are that NIT technology is now sold by the existing management to another group. It is held by PE funds, but and the name has also got changed. But the existing NIT was also again demerged, and its CLG business, the managed training business, was transferred to another company, which is NIT Learning Systems Limited. And the NIT continued to be a separate company, and the NIT Learning Systems is now a separate entity. So the technology-driven educational solution and managed service business was transferred. The global talent management and IT solution business remained with the NIT Limited, and both the companies are now listed companies. So the object was clear. Obviously, the two business were totally different kind. There was no direct correlation or connection between the two, hence required different kind of management expertise, and that made the management to decide to demerge the two into separate entities. So obviously, the consideration was there, 1:1 swap share entitlement ratio was provided, and through that we can see there is a unlocking of value. So the prior to the transaction, the market value of the company was around 5,200 crores. Post demerger, the demerged company is around 1,100 crore, and the resulting company is around 5,000 crore. Just the numbers are just after the demerger is completed. Now that numbers are quite different from that and enhanced in over a period of time. So that is the benefit. Similarly, the Tata Chemicals has transferred its global beverage business. So chemical business and the beverage business was totally different, and it has different, altogether different management style, different way of doing business. So it made sense to transfer the consumer product business into Tata Global Beverage. Tata Chemical is obviously a hardcore chemical company which has now transferred the FMCG business or kind of business which is directly relating to the consumer at large. This demerger has completed, and now we can see the benefit. The market cap of the demerged company was, at the time of the demerger, was 14,000 crores, and the resulting company was also a listed company with a market cap of 12,500 crore. Post demerger, the demerged company's valuation has got down, but became 5,600 crores, but the resulting company's value unlocked to a massive level, and now it is, just post demerger, it is 71,000 crores. So we can see the benefit of this demerger for the shareholder at large. Similarly, Adani Group and Adani Enterprise has demerged its renewable energy business. Obviously, the Adani Enterprise is carrying various kind of business, like in the natural resources, logistics, city gas distribution, energy generation, agri-business, etc. Everything is under Adani Enterprises. And out of that, they have removed the green energy business into a separate company, Adani Renewable. And that was a logical demerger for the benefit of the stakeholders, unlocking the value for and focus management. So it enabled greater management focus on the renewable power business, created enhanced shareholders value, and obviously independent collaborations were easier. So post demerger, we can see the market, demerged company's market cap was around 1,200 crores, 1,600 crores, and now it is 14,500 crore for demerged company, and resulting company is also around 4,500 crores. So there may be different and many other factors adding to the market capitalization of these companies, but one of the major reason was focused approach. The resulting company, which is purely in the green energy space, and it is a buzzword right now to have companies in this business. So there are focused investors who are looking at those companies, and they feel willingness to invest in such companies. So one demerger is Bajaj Electricals has demerged its power transmission and distribution business into Bajaj Projects Limited, another listed company. So transmission and power distribution business was totally different from the consumer product business like fan, electric appliances, etc. And it made sense to separate the two. So the demerger has obviously the logic of growth strategy, attract separate investors, channelize the resources, and the result is clearly visible here. Though not at immediate benefit was there, but slowly it is growing, and two different kind of business are getting separately listed. The government has also done this demerger of shipping corporation. Shipping corporation is a very old company, which is handling at least around more than 70% of the total shipping container business of the country. But over a period of this around 100-year journey, they have accumulated various kind of land across the country. And because the government was interested to disinvest the shipping business as per their policy, it was decided to hive off all non-core assets from the company to make it as a clear-cut shipping business company. So the Maritime Training Institute or the properties across the country were transferred through a scheme of demerger, of which we were the sole advisor. And through that, we have separated those assets to Shipping Corporation Land and Asset Holding Company, and it is now a separately listed, parallelly listed company. Shareholders got 1:1 shares, and both the companies are fully listed, now separately listed. So the pre-demerger, the market cap was around 5,200 crores. Now the demerged company is around 9,007 crores, and the resulting company is around 2,000 crores. So we can see there is unlocking a value, there is a benefit to the shareholders. Even if the government disinvest the stakes in the main company, the shareholders would remain shareholder in both the companies, and they can get liquidity for their shares. Same goes with other smaller companies. There are many companies like we have done for JHS Swendguard Limited recently, or in past also we have done many such cases. And every time we found that there is a unlocking of value through the scheme. So that is all we have seen. We can discuss other aspects, I think, during the Q&A sessions. I think Ashok sir is waiting for long, so we can.
Manoj, the example you have given, I think shipping demerger you have done.
Yes.
And some of the other.
We were also involved in the NIT case. Before that, Anantaraj demerger we have done.
So you just, after the Ashok's presentation, just share that in government, one example of government company, what is the example of private company, what problem they have faced. Okay.
Yes.
And
right.
what are the issues they should. Okay.
Right,
So now I will request Ashok ji. He is traveling, but he's kind enough to join the program. So Ashok, you are handling, Manoj is handling few cases and he has a knowledge, but you have a plethora of cases you are receiving. Any merger, demerger is taking place, this is going to your table. So what is your view about this entire thing, and what are the problems the stock exchange is facing on the compliance side? What are the issues which you think that this is a company should follow, or any advice which you want to give as a regulator. Please, over to you, Ashok.
Thank you, sir. Am I audible?
Yes, you are audible.
Okay, thank you very much. So this last minute came in, so I have to travel, but I still don't wanted to miss this opportunity of joining you all and get, my knowledge revised with the Manoj sir's, whatever he's sharing. So most of the thing from the listed domain, he has already shared. From the regulatory perspective, what are the regulations that are in place? I was just wanted to touch upon some of the experiences, like you said, which we have faced while processing these application. As already been shared, a listed entity, then we are in picture. They have to take NOC from the exchange, and in the process, uh, the comments are received from the regulator also. So this came into the picture in 2013 when the SEBI started giving their comments to the schemes. Before that, since 2003, only exchanges were giving their NOC to the scheme, and the reason was obvious that the promoter stakes, in case of simple merger, though this is demerger, the case of listed domain, their holding is increasing, and that is exempted in NSSC regulations. Valuation is a subject matter, and we as a exchange and SEBI per se, because of various uh, court judgments, are having limited say to say. But it still doesn't mean that we will not look upon the valuation and will simply allow any scheme to go ahead. Coming back to demerger, equity listed companies, they have to take approval under Regulation 37, and debt listed companies, they have to take approval under Regulation 59A of LODR regulation. In most of the cases of demerger, the mirror image is created, and these listed entities are transferring their assets to their wholly owned subsidiary because of business synergy. And that company is coming into the listed domain. Many of the times, it is having mirror image of the shareholding pattern. When the scheme of demerger is coming to exchanges, our focus point are three or four. Very first focus point is whenever the valuation is required, the valuation. Second, we are very cautious when pursuant to scheme, the category of the shareholders are changing from promoter to public, some part of the promoter to public, and otherwise. And the third point is, of course, compliance with the minimum public shareholding requirement. Recently, we have seen that one of the company, when they have taken stock exchange approval, they have submitted X shareholding pattern. And when they came for listing of the resultant company, like Manoj said, through seeking exemption of Rule 19(2)B from SEBI, the shareholding pattern was changed. And when we inquired why the shareholding pattern has changed of the resulting company, which is coming for listing, they said that now we have aligned with the more detailed provisions of who is the promoter, who is related to the promoter, and who is not, and kind of things. Then we explained to them that, sir, this is not how this happens. If exchanges and SEBI are giving approval to a scheme, and if you're making any changes, it is considered, especially changes in the shareholding pattern, is considered as a material change, and therefore, as per the regulations and the master circular on a scheme, you have to take a stock exchange approval of press. And incidentally, they have changed after getting the NCLT order. So the original shareholding pattern was only approved by the shareholder also. So that thing was undone, and then they have listed with the shareholding pattern for which we had given approval. But these kind of things we are very closely monitoring. We are also monitoring the scheme because under Section 230, so Section 5 of the Companies Act, um, as and when a scheme is filed with the NCLT, the notice is sold to the stock exchanges and to SEBI also. And we have very detailed scrutiny process of seeing the scheme, that the same scheme which we have approved has filed with the NCLT, one, and second is the things which we have asked company to do before filing with the scheme, that has been done. Disclosure, most of the time, say we ask them that you disclose this to the shareholder, is being disclosed to the shareholder in the form of notice that has been sent for the forthcoming meeting. So these are the checks and balances which we put in place to ensure that the same scheme which we approve, and give NOC has been put to the shareholder for voting. Coming back to the valuation, like we all know, valuation is the subject matter, and as per the court order, it should be left to the valuer. But it doesn't mean that we as an exchange will accept any valuation. We do our due diligence. And many times when we raise questions, either the company has changed the valuation and sometimes the company has withdrawn the scheme altogether. If the swap is involved for demerger when the mirror image is not created, the existing shareholder continue with the company and their company is getting a division of the listed company. And then thereafter it is coming for the listing. In that case, a detailed valuation of both the companies are involved. In those cases, we have seen that the value of the this unlisted company has changed multi times when the future projection of business is used as compared to what they have been doing and earning last so many years. And then we ask obvious questions because, like we said, this valuation determines the swap ratio, and basis on that, these shares are issued. And because the unlisted shares are coming into the listed domain, we are concerned with the valuation. So we look into the valuation. We do ask questions. We are do questions on the justification of the projections and all those things from the valuer. And like I said, either they sometime withdraw the scheme or they justify also, and we accept also. But we have seen that there are challenges in that part. That was point number one. Point number two, I asked, I just shared is the reclassification part. Sir, you are aware that in the LODR regulation, if somebody is shown as the promoter or promoter group, there is a way out to be declassified from promoter category, and that is regulation 31A of LODR. Now, there are checks and balances which have been provided in the LODR regulation to ensure that the person who is saying that I'm not associated with the promoter is actually not associated with the promoter and involved with the management of the company. What we have seen is that in many of the schemes, this the existing promoter of the listed company have been bifurcated between promoter and public category. Means some of the promoter is going into the public category. So we ask them to justify that on what basis they are declassifying the person as public category in the resulting company. And that time the questions are more inspired from the regulation 31A of LODR, which has checks and balances, like we all know, related to the reclassification. So that is the things which we have very clear concern that only the rightful cases should be moving out. Sir, you can just tell me whenever I'm not audible, I will repeat because.
No, you are audible. Ashok,
You are very much clear. Yeah, yes, sir.
Okay.
You are more clear than Manoj. You are in trade, even then you are more clear.
So that's the beauty of the infrastructure that we as an India have developed over the time.
Yes.
That in a running 10, I'm able to join and maybe seamlessly convey, and your people are able to listen.
Yeah.
Yes, sir.
Okay, anyway, so coming back to the questions, and then the question comes to the documentation side. Like we all know, we have prepared a detailed documentation that is required in the case of the merger and scheme per se, and that has been uploaded on the exchange website. We have put our numbers through which the companies can approach us. But there have been this question that the scheme are delayed at the exchange end, and but the reason for that delay is not necessarily that the exchange is not processing the scheme. We don't have that kind of option, being in listed domain and regulated by SEBI, as we all know. The point is that the documentation, though being very clearly given and transparent way to the public at large in an open domain on the exchange website, many of the time these schemes are not with the complete documentation. The query that we raise are not replied in the timely manner. Suppose we raise a query for the valuation purposes, okay, and then the company will not answer. They will go to the valuer. Valuer will take time. Then the company will take time. Sometimes they get involved with the legal team, and there is a lot of delay. So So we have now said that if you don't give the answer within a specific timeline, we'll return the scheme. So these are the some of the reasons because of the documentation and all. The scheme get delayed. Otherwise, we are very much clear in so processing the scheme and giving our approval because we are under a lot of pressure from SEBI not to, devote much time to the schemes. But of course, SEBI also understand when we tell them the reason for such delay. Third thing, in the case of demerger, when the resulting company is coming for listing, is the compliance with the requirement of minimum public shareholding. In normal cases, the shareholder of the listed company, they should get Mr. minimum 25% to enable the unlisted company to be eligible for the listing. Getting inspiration from the ICDR regulations followed by the Rule 92B, wherein if the valuation of the company is very high, the company can get listed with the lesser public holding, of course, not less than 10%. And that public holding can be raised to 25% within a period of 1 year, unlike IPO, wherein it is 3 years. We have seen the cases wherein their company has played many tricks to comply with the regulation for the resulting of the unlisted company. And when we asked the question, we actually identified this company is not in compliance with the requirement. So all I want to convey is that the cases of the schemes have been we have employed very experienced and senior people for processing the schemes. And we see compliance with the SEBI circular, we see compliance with the Companies Act requirements, we see the stock exchange separate requirement, and we look into the valuation, we look into the reclassification matters, we look into the MPS compliance matters, and then only we give NOC to the scheme because this is our job. And once NOC is given, it's not open for the company to do and make changes or do anything different basis on which we have given approval, because like I've said, under Companies Act 230 subsection 5, we are again seeing that the company is going to the shareholder with the same set of documentation in addition to the additional conditions are our NOC related to disclosure, so that things are in process. Once that scheme is listing of the resulting company is only a kind of formalities, because all due diligence has been done at the time of giving approval under regulation 37, because we cannot ask the company to go ahead with the scheme, get the NCLT approval, and then say no, now you have to comply with this new things. That is not good. So then it is only formality, and this is only compliance with the requirement which have been there at the time of giving NOC under regulation 37. So this is why I just wanted to share. I will be more happy to answer questions related to these themes.
Okay. Okay, Ashok, thank you very much. You have rightly pointing out that the valuation issue, reclassification through this process people do, and other compliance and documentation part. So substance is that one is the document should be very clear. Second is compliance should be there. And then valuation should be not favoring anybody at the cost of minority shareholder, and correctness of the valuation. These are the things, because sometimes people do the valuation to create a higher amount of the things. The share value, they are increasing in such a manner. So you are rightly pointing out, and reclassification is very interesting that you have pointed out. Now, friends, now it's a time to discuss about the questions. I have received 30 questions, 5 questions just now, and 25 I have received earlier. I'm just starting with this, Manoj. And Ashok, wherever you want to add, you can just add your answer. What are the issues involved in demerger of private company?
So in case of demerger of private company, mainly 2-3 considerations are there. The scheme should be qualified as demerger under income tax, so that exemption from tax capital gain in the hands of the company and the shareholders could be achieved. Then the accounting should be proper, so that accounting treatment is in compliance with the company law, and hence that is a prerequisite for any scheme. Then the cost of the scheme, which is mainly the cost of stamp duty or other incidental costs, should be minimum. These are the major considerations. Based on that, the schemes are framed.
Okay. Any challenge in merger of two Section 8 companies is consent of Income Tax Department mandatory, since they will be registered under 12A and 80G, and also since when Income Tax Department gives the registration, they have a standard line that their prior approval is required in case of any changes. Would IT department consent be mandatory?
Yeah. So whether or not Section 8 company, in all circumstances, wherever there is a merger or demerger, it requires prior approval, no objection from IT department, income tax department. So that is a standard regulator for any approval of the scheme. NCLT would not consider any scheme unless it is considered and no objection is obtained from the income tax department.
Okay. In case of demerger, where the net worth of a demerged company is positive and no liability but are transferred to resulting company is a new company, and where there is no arrangement with creditors, would NCLT dispense the meeting of the creditor where 90% consent of creditor is not obtained?
So legally it is not possible, but in specific circumstances, like in case of holding company and wholly owned subsidiary, NCLTs have given no objection, dispensation from the meeting of creditors as well as shareholders. So because the control remain with the same person.
Okay. Can we shift the registered office in the same state before merger in case of companies registered in the different state to follow the procedure and compliance only for one state?
Yes, it helps. However, you have to see the time and cost benefit of shifting of registered office and going through the process later, because even shifting of registered office would require involvement of approval from regional director MCA, and also no objection from various creditors. So which can be very time consuming also. So we have to see the pros and cons, and based on that we have to decide.
So otherwise, there are two states, then you have to file in
There may be two. Yes, the filing complication will be there. Hearings will be in different dates, and there may be double stamp duty liability also. So considering this one side, and another side is the time and effort required for shifting a registered office before merger process.
So how much time registered office change? 4 to 5 months?
Generally 2 months, 3 months. It is a 2 months process. However, sometimes because of no objection, delay in getting no objection from creditors, it takes longer.
Okay. If company is involved in a single business, that is a hotel business, at multiple location, can they plan demerger or only slump sale is possible?
Yes, it is possible. Geographical demerger is also a possibility. It is not necessary that two different kind of business can only be hived off through a scheme of demerger. It can be two geographical locations which need to be separated, and that scheme can also go through.
So for this type of company, I have 5 hotels. So
yeah, we can divide 5 hotels in 5 different companies. That is allowed.
No, so I can do the slump sale. That is a easy route, or demerger is a best way. What are the more advantages?
So here again, the cost implication would be important aspect. In the hotel business, the property size and value would be higher. So the stamp duty liability would be quite big. For slump sale, there is no exemption, no special rate. However, in case of demerger, most of the states have provided special rates which are lower than the normal convenience rate, and hence that saving can be there. Then again, whether the company has the capacity to pay the consideration in the form of cash or shares other than share, etc. That is the another aspect which need to be taken care of. In demerger, the by default consideration is the shares of the resulting company, but for slump sale generally it is the cash which is the consideration, and the buyer company or resulting company need to have sufficient cash to buy the asset. So it is advisable generally to divide the company in geographical manner and have the parallel shareholding structure in the two companies.
Okay. Manoj, this question is a little bit long, but Indian parent, wholly owned subsidiary in Dubai, wholly owned subsidiary in Dubai of B. Dubai, there are two companies, A or B. 70% is held by B and 30% held by three party from another tax haven places being closed and asset liability are transferred to D. Currently liquidation. After a few months, asset and liability will be transferred to E in Mauritius. There are a chain holding, intercompany loan and share application money in Dubai. No share allotment can be transferred above the CD and thereafter E. Reporting RBI, but it says, friends, those who have, anybody who has sent this question, its question is very complicated. Itself, when I'm reading A, B, C, D, E, F, G, and then, so this type of question is not, you can contact Manoj separately. He can give you answer because today we are talking on the open forum and something is wrong. It is not correct. So I have a few more questions. How should the accounting be handled for demerger in financial records of both the demerger and resulting company?
So income tax clearly says that all assets and liability of the demerged company should be transferred and recorded by the resulting company at their carrying book value and ignoring revaluation if any. But obviously, in case it is a NDS compliant company where all assets are carried in the books at their carrying book value, fair value, then that value would be considered to be the book value for the purpose of demerger. So though there is no specific accounting standard prescribed for demerger as such, like in case of merger or amalgamation, for which AS 14 is there for normal cases and Ind AS 103 is applicable to company which are following Ind AS process. For demerger, there is no specific law, but the general accounting principle is applicable, which is called the Indian GAAP, which is applicable. The guidance notes are there from Institute of Chartered Accountants of India. The guidance note says that all demergers should be accounted in the form of purchase method of accounting, where all assets and liability should be recorded at their value, carrying value, and consideration should be recorded separately by the resulting company. However, for India's, since the India's has come, there is no specific law provided, and the general practice is, because it is India's 103 is accounting for combinations, that business combination, it is also a business combination, and the resulting company hence considering the fact whether it is within the group demerger or outside group demerger, use the pooling of interest or purchase method. So all assets and liabilities are recorded as per their carrying book value, and if there is any identified reserve relating to that division, that is also taken over by the resulting company and recorded in their books. Then the shares being issued also recorded in the books. So, and that if there is any difference, that is considered to be capital reserve or goodwill, as the case may be.
Okay. Ashok, in your career, how many cases you have written because of certain reasons, say maybe valuation, maybe compliance, maybe other thing? Can you just highlight that some cases which you have written or which you have asked them to modify?
Quite a few, sir. Quite a few.
Okay.
And these cases, I mean, in my time, at least 8 to 10.
Okay.
And out of that, maybe 5 to 6 in last 2 to 3 months.
Okay.
And the reason for them, I mean, there's hardly anything you can do with the net worth, hardly anything you can do with the other method. Only two methods which we have found ourselves very obviously uncomfortable when we see from the common sense point of view. I mean, though having knowledge of being CA. One is the, of course, future projection, and another is the comparable company method. These two methods companies have used in a very arbitrary manner.
Okay.
And when we ask them to justify, I mean, they have started giving justification, but then they have the justification were also of no sense. Then they have withdrawn. We asked them that better you withdraw, and they were smart enough to withdraw. Because if we reject, then we have to upload on our website. That creates a negative picture.
Okay. So now, Manoj, can a partnership firm demerger in business division through a scheme of arrangement?
No, so company law is not applicable to partnership. If it is converted into company and then we file a scheme of demerger, that is a possibility. So there is a special provision in the Companies Act where partnerships can be converted into company through a process called capital conversion of partnership under section 366. So that can be applied, and company can be partnership can be converted into company, and then demerger may be possibility. However, we have to see the tax implication at the different stages.
Okay. What are the key pointers that the stock exchange oversee while approving the scheme of merger? Now, Ashok has mentioned now from the practicing side.
Yeah.
What do you see?
So, as Ashok sir was telling, that those are the major thing. Basically, when the scheme is being filed under Regulation 37 for approval in no objection from stock exchange and SEBI, it should be fully as per the checklist provided by the respective stock exchanges. The fee is properly calculated and paid. The scheme has all the components which are necessary, like various disclosures respect to whether there will be requirement of whether the promoter's holding is increasing as part of the scheme, and whether the majority of minority approval is required or not. That should be certified by the auditor of the company. Then the pre-post shareholding structure is properly defined, with like if there are certain persons who are already shareholder of resulting company and before the scheme, and they are being classified as part of the promoter group, whether they are exempt under takeover regulation or whether they are holding shares in the public category right now. So what is the treatment for all those things, whether there is any convertible instrument in the demerged company, and what will be the treatment of that, whether there will be any other kind of instrument available in the company, what treatment is provided for those. So these are the basic things. Then the valuation and swap ratio or entitlement ratio. So the problem is mainly where there is an existing company which is being used as a resulting company. If it is wholly owned subsidiary and parallel replica is getting created, mirror image is created, in most of the times stock exchange does not create any problem, and if the paperwork is proper. So
Your statement is not correct. Stock exchange not creating problem. Stock exchange.
Yeah, so that's what I'm saying. It will not be a problem for anyone because it is a parallel replica shareholding structure. Yeah.
Okay.
Just to have here.
Yes.
One thing I should have shared, and just now remember when Manoj is talking.
Yeah.
Majority of minority shareholders approval that is provided in the master circular.
Yeah.
In the cases, specific cases, for example, this public holding is going down by more than 5%. Promoters are getting shares and all. So provisions of the circular are very clear that in all these cases you have to take approval from the majority of minority, means majority of the public shareholders. It's not a special resolution kind of thing.
Yeah.
Only thing is to majority. But
Simple
what we have
majority
seen that simple majority of minority, and which is very good thing to have in a listed domain, again,
Yes.
because of the obvious reason, because public money is involved. But what we have seen, sir, is that many schemes being delayed, and some of them they have withdrawn also. When asked them that in your case majority of minority is applicable, and they
Keep it down a bit.
Yeah. Thank you. So and then when we say that it is applicable to you, they were kind of not agreeing that they come with all their guns and everything. So I mean, in my view, this is something which should be there for every scheme, because public shareholder and shareholder activism has come long way, and their views are very important. But I mean, that is my personal view. Going by the regulations, this need to be followed. I mean, people should be sensitive when they are claiming exemption, and there should be compliance with the regulations.
Yes, perfect. You are right. Manoj, whether any extension can be sought if the company fails to file the application to NCLT within 6 months or receive an in-principle approval of the scheme?
I don't think there is any specific provision. Generally, it would require a new scheme, fresh scheme filing with the stock exchange for their no objection. Because time, 6 months is very quite long time. If even post no objection from SEBI and stock exchange, you are not filing with NCLT, then there might be a requirement to look into the valuation, swap ratio, etc. So it is advisable to refile the scheme.
Okay. Ashok, have you seen this that people have come for extension from your side if they are not able to file within 6 months, or you have any objection in this?
Yes, we have objection. If they have not filed within 6 months, a lot of things change, valuation change. 6 months is a considerable time. And 6 months is from the NOC. Suppose you have taken approval for amalgamation or anything and valuation is involved. Valuation is a few months earlier than what the date of we have given. So by the time 6 months pass, the valuation may be 8, 9 or 1 year old. So we have not given any extension of NOC
Okay.
for the 6 month period.
Or valuation and what is the valuation? How much, how old valuation you are accepting, and when you are saying to change this? 6 months or 3 months?
When we approve a scheme, we say that it should not be older than 3 months. I mean, it should not be valuation is of course latest, but it should not be based on the financials which are older than 3 months.
Yes. There is
Okay.
a specific SOP for this. The valuation related SOP is already provided for scheme of arrangements. So which clearly says the financials being considered at the time of valuation should not be older than 3 months. And again, the NCLT rules also provides that at the time of filing of the scheme before the NCLT, the company must provide a latest financial which is not more than 6 months old. Only difference is in case of SEBI regulation, the master circular and SOP, it is audited financials, whereas NCLT does not insist on the audited financials.
Manoj, now it's a rapid round because I have so many questions. So I just want the very crisp answer.
Yeah.
How can a shareholder holding shares in physical form receive his or her entitled shares in the demerger?
Now the law is very much clear that those shares would be need to be issued in demat form only. So they will be kept in separate account as on behalf of them, and as soon as they get the demat connectivity and provide, the shares would be credited in their account.
Okay. How the shareholder, if the slump sale is a time-saving process, why do entities opt for demerger?
So, two reasons. One, in case of demerger, there will be so the consideration is paid to the shareholder directly, and there is no need to pay cash against the business being acquired. So the acquirer company may not have sufficient cash to buy the asset, and in case they issue share, then it becomes a subsidiary of the company which is transferring the business. So that may not be suitable structure. Then there may be other consideration like larger strategic issue, like in case of listed company, if you are demerging, you get two parallelly listed company, which is a good unlocking of value for the shareholders involved.
Yes.
So these are the considerations mainly.
Okay. If on the date of listing of the resultant company, how the share price is determined? Ashok, can you just explain? Because two companies are separating, so how the share price they are determined? Stock exchanges.
Sorry, can you repeat?
When the demerger is taking place and the two companies are listing on the stock exchange, so how the stock exchange determining the price?
This is always determined based on the valuation report, and then their share price is one of the criteria in case of listed companies are involved. And in that case, date of approval of the scheme by the board is considered as the relevant date, and then the backward calculation happens.
Okay.
So, I mean, stock exchange doesn't determine, we just go by the valuation report.
Sir, just wanted to interject here that for on the date of listing of the resulting company, there will be pre-open session, like in case of new listing, IPO listing, and through the equilibrium price determined through pre-open session, the price is determined, and that becomes the base price for further trading on the stock exchange. So the resulting company is listed valued accordingly, and the demerged company is also on the X date of the scheme, record date, post record date, X date is determined. On that day, the price is split. So again, pre-open
So
session
it is
happens
only
and the
the
price.
basis of valuation as well as
Yeah, so base price may be through the valuation report, but listing happens based on the buy-sell equilibrium
Okay.
price determined through pre-open session.
cherry picking of
So-
asset liability under slum sale is
Sorry,
allowed.
sorry. I think Ashok sir was wanted. Yeah, sir. Yes, sir.
Yeah. So when I say valuation report, I think I misunderstood maybe the question. I was talking about Regulation 30. I thought that is the price which we are talking. We were talking about the price of the listed company which is getting listed through scheme of arrangement.
Yes, sir. I think that
And
is
I
the
go by the what Manu sir has said. It is we have some dummy base price, and this is purely determined on the pre-open session.
Okay. Manoj, the cherry picking of asset and liability under slum sale is allowed or not?
cherry picking means if we are not fulfilling the definition of going concern, then it may not be considered to be a slump sale, or it will not be a going concern transfer. So there will be GST implication to the transfer, and there will also be no exemption from the capital gain, even if it is transferred to a wholly owned subsidiary.
Okay. How is the value of the entities involved in the demerger enhanced? Because one company divided into two parts, so the market capitalization is high. That is the question.
So it totally depends upon the perception of the investors community in the market about the two different businesses. When two businesses are blend into one, generally it is difficult for the investors to determine which business component is creating how much value, and hence they give the lower valuation multiple to the stock of the company. Then there are various shareholders who are industry specific or sector specific. So in case of blended company, they do not want to venture into those shares. So demand is low. But as soon as you demerge the companies and keep the two different kind of business separately, then there will be particular investors who are willing to invest into those shares, and hence the demand increases. The demand obviously creates increase in value of the shares. So that is the demand and supply game basically.
Okay. Does Section 233 apply solely to merger, or does it encompass demerger as well?
No, 233 includes merger as well, demerger.
Okay.
And
Are
we
there
can do
any-
demerger of wholly owned subsidiary or small companies through fast track route under 233.
Okay. 233.
Yes.
Now, does Section 233 apply?
Yeah. Right. That's what I'm saying. Demerger can also happen through the fast track route, RD route under 233.
Okay. Any other separate provision for cross-border merger, cross-border demerger?
So cross-border demerger provision is not there. Specifically, it is cross-border merger provision, which is provided under Companies Act and as well as the rules. So we may consider that demerger is also kind of merger, part of the merger, and can be approved. But there is no precedent. I think there are objections also from some RDs that the provision is not relating to demerger and should not be applied here.
Okay. How the dissenting shareholder treated in the demerger?
So Companies Act says in case of dissenting shareholders, they should be given exit with the appropriate value. And for that, SEBI need to, in case of listed companies, SEBI need to prescribe the formula for giving exit valuation to those shareholders who are objecting to them. But that I think apparently SEBI has not specifically come out with any method. So we can consider maybe some the valuation prescribed in the scheme can be a criteria to give the exit to the shareholders.
Okay. Can an undertaking with negative net worth be transferred by slump sale?
Yes, slump sale can happen to any kind of thing. It is a business which is getting transferred. So valuation may be a challenge, but if it has a future prospect, then even a loss-making business can be transferred through slump sale.
Okay. What are the potential risks and challenge in company faces in case of demerger?
Challenge also like we have discussed all those things. Besides the regulatory aspect, there may be procedural aspect, there may be time for the time being disruption in the supply, or let's say branding change, etc. So, or HR related issues, shifting of certain employees. There may be certain employees who are working for both the companies, how to manage those. So those HR issues may be there, then there may be procedural issues, etc.
Brief.
Yes.
There's some more question. What are the accounting treatment for slump sale transaction?
So slump sale, again, it is relating to the same. There is no specific provision for slump sale. It has to happen on the best case scenario, which is applicable, the Indian GAAP.
Okay. How the company determines the share exchange ratio in demerger?
So if the companies are already in existence, both the company, then there will be valuation of the two company, one division which is getting transferred, and that resulting company, and swap ratio is determined. In case parallel vertical split, there is account entitlement ratio, which is based on the management discretion.
Okay. How the company determines the share exchange ratio in demerger? Whether the restriction on execution of contract rate applicable in case of demerger?
No, that is not applicable. First part, I think I have discussed already.
Okay. How the list of shareholder is determined for the purpose of issuance of shares?
So there is a record date which is fixed post approval of the scheme, and on the record date, whoever are the shareholders would get the shares from the resulting company.
Okay. Resultant company get itself listed on another stock exchange?
No, it will get listed directly in the same exchange where the parent company is listed.
Okay. What is the treatment of depository receipt in case of demerger?
Depository receipts, GDRs, or as ADR,
Yes.
GDR.
Yeah.
It will be because in ADR, GDR shares are underlying shares are already issued, so they will also get the shares against the demerger scheme.
Okay. AS 14 applies to demerger. What is the AS Ind AS applicable on demerger? Number the second. Saving Master Circular says that percentage of shareholding of pre-scheme public shareholding
should be 25%, at least 25%.
Qualified buyer to be of the unlisted.
Yeah. So accounting treatment 103 is there for business combination. India's 103 is there. So that is applicable to the resulting company, not to the demerged company. Demerged company has to account for according to Indian GAAP.
Okay. So I think we have covered all the questions. So, and the time is also 6 o'clock as we have to close this session. So Ashok, as a ritual, we are asking the concluding remark from your side and Manoj. So please, Ashok, can you give your concluding remark on the basis of demerger on whole aspects of this?
Yes, sir. I mean, from the listed domain side, my concluding remarks are like my opening remarks. Valuation, reclassification of shareholders, and compliance with the MPS requirement. These are the three key aspects that we are looking into. And the things are already in public domain in the form of SEBI Master Circular in our checklist.
Okay.
And if the companies are complying with those requirements, it's a very fast and quick that.
Okay. Manoj, your point, your view.
I think, sir, the strategic objective of demerger, if carried properly, has a tremendous potential of unlocking the value. Even for unlisted companies, segregation of the business, focused approach, focused management always helps in growth of the businesses. So it is the right time. If the size of the business is substantial, it is always advisable to have separate companies for separate kind of businesses. It helps to attract the right kind of investors and also unlock the value for the existing shareholders. So it is always good to have separate entities for separate class of companies, unless the size is very small where it is not feasible to have economies of a scale to have separate entities.
Okay.
Companies should go for that. And
So
we have seen this benefit to many of the listed companies. Yeah.
So thank you very much. Thank you, Ashok. Despite of traveling, you have participated, given answer, addressed the participant, the stock exchange concern, and how they can take advantage of the faster process. through proper checklist and proper document compliance and valuation report and other aspects. So thank you very much. Thank you, Manoj, for giving an elaborate answer as well as presentation. This presentation we will share to the participant. And my last concluding remark is that demerger is one area which is very, very important. And we have done some poll also. So what integration challenge do you anticipate post-merger of Hive-off? Human resource. So this is the most important thing which people are saying when you do demerger. Yeah, what aspects of legal and tax implication concern you most in the demerger? Stamp duty, that is also. So people are not bothered about the capital gain, but stamp duty, this is the things which they bother. So friends, the demerger is one of the best tool to get the valuation of the right kinds of, because you have a multiple business. Today, the one person has asked question that he has a 7 hotels, all different jurisdiction. So it is not possible that all hotels are working proper good. There is some problem also. So if he is getting a say X value, but he divide these 7 to 3 companies or 4 companies or in 7 companies, he'll get better valuation. That is absolutely sure, because that is one added advantage that investor and everybody is clear and they invest. Sometimes investors are focusing on particular industry, particular location, particular area. There also a chance that you get additional traction also. So demerger is very good. I have seen, and Manoj has given an example, I have not seen any company which has destructed the value of the demerger entity if you combine. Manoj has shares, and we have done this work of Anantraj industry. Their share value of the combined entity was 20 rupees. Today, after the demerger, when both the group has started their own business and one group has converted into data center also, so their combined valuation is today is 700 rupees. So just understand that 20 rupees value, 20 rupees per share value, it has now 700 per share. And this is the beauty of demerger, because every investor got a clarity that what business they are doing and where we should do. And sometimes management role is also very important. I don't like one management, I like other management, but both are combining, so I'm not giving value. So this is another aspect. The aspects of location I have told you, aspects of business I have told you, aspects of investors' interest I have told you. So multiple benefit is there, but it is not a just cakewalk. It is a complicated process. You have to understand the company law process. You have to understand the valuation aspects, because stock exchange is always checking. You have to understand the SEBI regulatory aspects, which is very tough, because first it is going to stock exchange, they analyze, and then it is going to SEBI. And because you are getting 2 companies, 3 companies, 4 companies by doing demerger by through 19(2)(b) route, and without going to public, you are going as a 2 listed company. So that is also another advantage which you can gain. So SEBI looks and asks so many questions. Demerger of holding and subsidiary, merger or holding and subsidiary, demerger, they allow when there is a replicator, the total same shareholding and same shareholding is here, they do this. But rest of the things they check. Then come to the stamp duty. This is the aspects where the value addition and value creation you have to analyze on the basis of outflow, and then tax aspects. So this is not a cakewalk. You have to see 360-degree advantage, business, as well as all these complications. But professionals are there, those who are expert. Manoj has done more than 50 demergers of listed and unlisted company. So he has understanding of all these things. So that way we talk to the professional and do this. So with this, thank you very much. Thanks Ashok, thanks Manoj, and thanks all participants for joining us. And friends, this journey of knowledge sharing will continue. And our next program will be on the next Friday. That is our 184 webinar on 9th August. And we'll see you. The topic we'll share with you tomorrow. With this, thank you very much.